Hi everyone, this is Gary Wilson and welcome to tonight's live investor agent training program. Welcome to all the folks in the investor agent training program, and welcome to all the folks who've taken the flipping for profits training program and rental profits is at the pain, or the turning rental problems into real estate profits. That's the property management course, and that was a big hit. For those of you who've missed any of those, they're all available to you online on the My Investment Services website. And as students, while you're a student, you get to take them for half price. Now there was a Christmas special we did this year. We didn't do it in previous years, and we kept getting a lot of people asking us, can we do something special at Christmas time? So we did. I don't know if it's still an active offering right now. You have to check with Beverly. But what she was doing was, for about a week or two, any student can go on and purchase any of the other programs, and when you do, you would get a second program for free. And I know that sounds like, well, you already get that. If you're in, you can bring in you can get another program for half price. But that's different. You're already in. You paid full price for one. Yes, you can get any other program for half price. So this was definitely unique and special, which is, buy one program, get a second one completely free, and you still get to bring in partners. So you literally, in other words, that's the second program for free. You literally, for the price of one training program, could get 4 programs, 2 of one and 2 of another, if you bring in partners. I mean, that was just unheard of. So I hope many of you took advantage of that. If you're not sure about what it is I'm talking about, let me know. Please check your emails, because you don't want to wait. I think that's going to expire this week if it hasn't already. So, in any case, welcome aboard, everybody. Newer students, senior students, no matter where you are in the U.S. or Canada. Tonight we're going to go over the top 10 tax strategies for investors. And again, this document is on the My Investment Services website under the member section. You have to page down past the recorded webinars and the interviews, and you'll see a lot of material there. It's available to you to download. Okay, so you definitely want to do that. It's free for you, and you also want to provide that to your investor clients, particularly this time of year. And I know I'm going to repeat what I was going over prior to the recording, but this is an awesome time of year to be going over this, because you want to provide this to your clients. All right. The reason is the timing of the year. Coming off the holidays, after January 1, most people are going to be thinking about tax preparation. So it's not just that you're going to give them a free gift. You're going to give it to them in a timely fashion, in a time of year that actually makes more sense to them. Okay. So in any case, let's go ahead and let's get started here. But let me check for questions first. Looks like everybody's just saying they're logged in. They can see me and hear my screen. Okay, that's wonderful. So I'm going to reduce the panel so I can see more of the document here. So everybody should be able to see this, right? So just, guys, get out some paper, pen, and pencil. Be ready to take notes. If you already have this at your disposal, you've printed it. If you want to go ahead and print it now, go ahead and print it now. You can print it off, and you can make little crib notes as we go through this. That would be a very good idea. Okay, so let's go ahead and get started here. First things first, we're going to go over perhaps one of the in my mind, one of the more complex strategies. Okay, it has to do with passive loss limitations. Now, over the years, the rules have changed, and it seems like they just keep modifying things, and some are better for us, some changes are better for us, and some changes are not so good for us. But let's talk about the basics here for passive loss limitations, right? It says right there in the title, avoid passive loss limitations, deduct unlimited property taxes, even if over $25,000 or your income is over $150,000 by being a real estate professional. Okay, so let me just go into this a little bit so it makes more sense. First off, okay, come on, computer. There we go. Depending on your particular financial and tax situation, in any year, let's say you have at least paper losses on your property, so up to $25,000. Okay. and you have gains of greater than $25,000. You can offset those gains by the losses on your tax return. Okay, now it has to be like income. In other words, you're the property owner, you're the landlord, you have rental income coming in, and you have losses as a result of those owning those properties. You can offset your income from the properties by those losses. It used to be you could offset other income from other sources, but if you read this, you'll see what this means is real estate investors cannot deduct property tax losses against non-passive income, such as salaries, business income, gains, IRA distributions, etc. In other words, you can't use this to offset earned income, right? But you can also use it to offset business income related to the business of real estate. So if you have an adjusted gross income, and by the way, if you have an adjusted gross income of over $150,000, you can't even take the $25,000 exception, all right? So in any case, what we're talking about here is this. If you have, let's say you have these losses, right? And you want to take advantage of them. What you can do is, the way that the tax laws work now, the default is that these are suspended. These losses are put in you think of it as an escrow, although it's not really an escrow. They're basically put on ice until you sell the property. And then you can offset the gains on the sale of the property by these accumulated losses. So let's say you had losses of $25,000 for 3 years in a row for a total of $75,000, and you sold the property and you made $100,000 net on the sale of the property. You could offset the $100,000 gain by the $75,000 accumulated losses over the last 3 years. Now, there used to be a limit on how many years you could accumulate losses, what they call a rollover, all right? And that's changed over the years. I don't know what it is right now. At one point it was 6 years, and then it was 3 years. Just know that if you can't take your losses now, at least in the interim, you can defer those losses. You can use them later to offset the gains on a sale. But there is another approach, okay? This might not seem too appealing to you, but there's an absolute better approach, and here's what it is. As you know, rental income is defined as passive income, which is really unusual because obviously we get involved with buying and running our rental properties. You're maybe not doing painting and plumbing and so forth, but you're certainly in control of your rental properties. Maybe you hire out every single thing that has to be done, but you're still the owner. You still get involved. You still spend time on those properties. Okay, so what I'm getting at here is this: you can use you can document. If you can document at least 751 hours, okay, in a calendar year that you devoted to your real estate business, and this amounts to about 14 and a half hours per week, essentially 2 hours and some change a day, okay, not hard to do. So in other words, you can have a full-time job, all right, and if you're putting in 2 hours a day on your investments, you can construe that you can operate this as a business. You're operating this as a business to the tune of 14 and a half hours a week or 751 hours in a year. Okay, so if you spend that time in real estate, on the real estate business, trade or business is what the definition says. So let's go through this. What that means is could be property development, redevelopment, construction, reconstruction, acquisition, that's you purchasing properties or your clients, conversion, converting from one use to another, renting those properties, operation, in other words, operating the rentals, management, leasing, or brokerage, trade, or business. Many of you are in the brokerage business. Most of you are, in fact, okay? So what I'm getting at is this. If you're a real estate investor and you do rentals, management, rehabbing, wholesaling, retailing, foreclosures, short sales, self-storage, other types of real estate activities, this includes you, all right? So with the right planning and documentation, you can construe that you are running a business, and then you can take all these losses in the year that you accrued them, okay? So you can do this and fully deduct your property tax losses without limit, save a ton of taxes, and increase your cash flow every year. So in other words, what I'm getting at is there's no limits on that, all right? And this is what I've done for years, many, many years, okay? And all of you and your clients can do the same thing. So what I would do if I was you is I I would print this off if you haven't already printed it off. I would review this, sometime tonight, tomorrow, Thursday, Friday, what have you, so that you're a little bit more familiar with it. And then at the same time, send it to your clients as a gift, all right? And just be prepared to support them come January 1, all right? Because they may ask you where you got this. You can just say you got it from My Investment Services. It's been certified by a tax accountant. It's all stuff that I've done. So in any case, just keep that in mind. There's more to go over. I just want to kind of lay the groundwork here with this first one. So I want to make sure everybody here is comfortable. So let me move my panel over real quick and check for questions. So hang on just 1 second. Let me get that back over. Hang on 1 second. I know there's going to be a lot of questions here tonight. I get it. Some of them I can answer. Some I can't. So Faisal, what you want to do is log into the My Investment Services website. So if Faisal's asking, where is this? So you go to the My Investment Services website, go to the member section, and when you log into the member section, you're going to drop all the way down towards the bottom. It's several screens long. You got to go through the recorded webinars, go through the recorded interviews, and then you'll get into the area that has related files and documentation that are related to the program. Okay, and you'll see it in there. And it's actually titled Tax Strategies for Class 1. So that's where this is. Awesome stuff. If you have a workshop, you can bring that to your next workshop and hand it out. Hey, by the way, Faisal, if we have time tonight, if you don't mind, I want to ask you about how your workshop went the other day. Maybe you could type it in real quick. Just let me know the number of attendees and things like that, and we'll go over that. Okay, so let's go over to the next strategy here. All right, this is ways to audit proof your, in other words, your returns. I can tell you, let me just tell you, the bigger you get, in other words, the more properties you have, the more businesses you own, the more likely you are to be audited. And I've been audited a number of times, but I will tell you this, an audit is nothing to be afraid of. Really all it is, guys, and you can really relax and breathe a sigh of relief, they're simply looking for more information. That's typically all they're doing. That's what that means. Auditing is, they're going to audit, go through everything, and if they don't feel like they have a complete enough explanation on any one or any number of things, they're going to ask you for more information. That's all I've ever done. I've never had a return actually adjusted because of an audit. That's just, they would always come back and say, okay, we're good. We're considering this closed. So don't be afraid of an audit. The IRS you should view as a partner in your business, just like an attorney or a real estate agent or a title company or an inspector or a contractor or a lender. The tax code is written to be used, and so many people do not even use a fraction of the tax code. Now, granted, the tax codes are ridiculously long, but if you have a tax accountant that knows what they're doing with investment properties, there's a lot you can take advantage of. That's what we're going over tonight. Okay, so it's not something to be afraid of, or holy smokes, is this legitimate or I'm gonna get in trouble? No, you just have to follow the rules. Okay. So, in any case, again, hang on 1 second. Somebody is asking me for another question here. Let's see. This is Beth. Please tell me where to find a document on the website again. And that was sorry, Beth. So go to My Investment Services website. Up across the top, on the bar across the top, you're going to see a button you can click on. It says Members section or Members Only. I forget. If you've been in the program for at least a month, that's when Paul adds you to that section. Excuse me. You log in, and then you get access to all this. And all of these forms and documents are at the bottom of that member section, and they're yours to download and print and really keep forever. So, in any case, let's see. This is Roger. Roger said, I'm having some issues with the audio popping in and out, sometimes 5 to 10 seconds. I'm not sure why, Roger. Let me just check real quick here. Mine is, yeah, mine's 100% here. Now, Roger, that has happened to me on other webinars that I've been on, and what we determine is actually internet related. Your server, you might have so many people logged in right now in your area that your internet provider is just really struggling. I mean, that's the answer that was given to me. So I apologize. Hopefully it'll clear up. Okay, so back to this. There's a lot of ways to reduce the chance of audit on your returns, because let's face it, even though an audit is generally not something to be afraid of, it does take time. I mean, it takes time and energy, and boy, you really got to be prepared and have your ducks in a row. And the more you do, the less time it takes. But just be prepared. It could chew up, a couple hours a month for up to a year easily. So, in any case, one of the first things you can do, one of the easiest things you can do is this: simply file an extension. Okay. Now I do that every year, not because it's a technique I use to not get audited, but it's a necessity because my tax returns are so lengthy. It takes my tax accountant. He has to wait till the season's over before he can start on mine, and several other business owners he has like me, and it takes him that long to go through it all. I mean, we're talking a several hundred-page return that he's preparing, and he has to file things in multiple states because I do business in multiple states. So it's a little bit more complex, but the bottom line is I file an extension every year for that reason. It takes him that long to do it. But as a result, what happens is it reduces your chances of being audited, because throughout the year, the IRS is identifying other audits, other returns to audit, and if they've basically filled up their queue, they're not going to get to you. It's like a first come, first serve kind of thing there. So, in any case, to do the extension, you file Form 4868 for individuals and 7004 for entities like LLC. So, most of my return is taken up in the form of entities. My personal return is not all that great, but all the businesses added up, all the LLCs for property ownership, really add up to a lot. So, in any case, that's the first thing is simply file an extension. Okay. Now the reality is it doesn't mean you get to postpone paying your taxes. So let's be real here. You still got to pay your taxes. So if on April 15th you believe you owe $1,000, you should send a check for $1,000. You can postpone the filing of your return, but you cannot postpone the payment. If you believe you owe money, by gosh, you really should pay it. Okay. In any case, let's keep going here. That's because that's a real easy technique. All right. Now another thing too is, let's say you have something that's not really. Maybe it's a little more complex, or the type you have a related business that's a little more. It doesn't fit one of the models very easily. Okay. So what you want to do is you want to provide a written explanation, and I do this too because I have a lot of travel, and that's one of the things that can trigger an audit is, I mean, I'm constantly submitting receipts for room and board, because I'm constantly traveling. So I just simply explain, well, this is one of my businesses that I'm involved in. I'm at least part owner of it, actually. But more importantly, I'm the lead trainer, so I'm the one that goes out there on the road. They get to use my name and so forth to do this. So I do that, and I suggest you do it too. So if you think there's a transaction in the year that's not a traditional type transaction, it was a little more complex, multiple moving parts and pieces, provide a written explanation to explain it. That's all they're asking for. Okay. In fact, if you look at this statement here, I would copy this right here. All right. I would include this exact verbiage starting right here. Auto, entertainment, travel deductions are necessary for my business and are done in strict accordance with the substantiation requirements of IRS Regulation 1.274-5T parentheses C. Okay, you always want to refer to the code, the regulation, and explain why. So you want to let them know that you're prepared as you got all of your ducks in a row. So that's the second easy thing. So there's a lot of other ones, but those are the two easiest things you can do to reduce your chances of being audited. Okay. Now another thing is this: the purpose of utilizing the tax code in your favor is to retain more of your income, so you have more income available for investing purposes. And I know it sounds obvious, but let's just go over an example of how powerful this is. And we're going to talk about the power of compounding. Some people refer to it as the eighth wonder of the world. So if you take $1 and you double it every year for 20 years, actually that's just 20 days, that should say 20 years, excuse me. I wonder if it'll let me edit this right here. And it's funny because this, see, tax accountants are, you'd think they would catch that. But in any case, so if you double the dollar every year for 20 years, it'd be worth over $1 million at the end of 20 years. That's pretty good, right? Okay. Now let's say your that same dollar is taxed every year at 30%. Okay. That reduces your total gain on that dollar to a mere $40,000. Nothing wrong with $40,000, but let's face it. Would you rather have $1 million or 40,000? I'd rather have $1 million every single day. Okay, so if you can reduce taxes, if you're in a 30% bracket and apply whatever your savings are to some form of an investment, it's like you're much further ahead. It's a double benefit. You're not only reducing expenses, you're increasing your income. Okay, so in any case, tax-free compounding is a pretty critical component of the tax code. And again, it's not any secret. They know this because this code was written, by accountants and attorneys, and most of it comes from legislation. It's passed through Congress and the Senate. Okay, so in any case, the bottom line is this: because the tax-free compounding earnings accumulate not only the principal amount, but also they accumulate on the tax-free earnings as well. Earnings on earnings, in other words. All right. So the compounding combines earning power on principal and the earning power on interest. Here it is right here. It's been sometimes termed the eighth wonder of the world. It's like a miracle. Okay. So wealthy people knew this. Affluent people know this. Okay. And so let's say you can save $2,000 in taxes by applying the appropriate code, and you invest this in an IRA. If you invest it, beforehand, after a 20-year period, and you keep this invested for 20 years, you got a whopping $114,000, right? But let's say you save $10,000, all right, because you apply the tax code. That goes up to about $573,000, additional to your bottom line, all right? So you see, this is why. So you don't want to just save on taxes for the sake of saving on taxes. You want to save on taxes for the purpose of redeploying that capital for a greater good. Okay, does that make sense? Let's say you save $5,000 and you use it as a 10% down payment on a property. Okay, that you bought a $50,000 piece of property, and assuming a 20% yearly return on the $10,000, okay, at the end of 5 years you'd accumulate $50,000. All right, 20% on $50,000 is $10,000. Right, so 10,000 times 5 is $50,000. You see why we like to save taxes. All right, so always make sure you use the appropriate tax accountant, which we'll talk about here in a little while. So in any case, you can also use that money to upgrade your properties, right? You can upgrade your properties, increase the rents as a result of you applying your tax savings. And if you did that, essentially what we're talking about here is you can add at a 10% cap rate. If let's say you added $200 more per month to your cash flow, that's $2,400 a year, divided by the $2,000 that you put in there, and the improvements to result in that, that's 120% gain. Okay, so before I go further, let me queue up method number 4, and I'm going to check for questions here real quick and take a pause and let you guys catch up. Let's see. Okay, next question. This is from Tanya. Hey, Tanya. Tanya says, okay, will the username and password to log in to My Investment Services memory area be sent to us via email? Yeah, so Tanya, once you've been in, whatever month you join the training program, whatever training program you join, at the end of that month, I think it's like the first business day of the following month, Paul adds you to the member section, and you're going to get notified via email. But what they started doing is, just in the last week or so, I think we encourage them to add students to the member section as they as they get their training material. So you kind of get both at the same time. I don't know that that started, but I think they were going to be starting that this week. So keep an eye out, everybody, for your emails. If you're new within the last month, please keep an eye out for emails and go ahead and log into the member section, all right? In any case, let me check real quick here for more questions. Hang on one second. Okay, I think we're okay. Okay, let me go ahead and go to the fourth one, all right? Depreciation deductions, right? You want to increase your depreciation deductions via componentizing, all right? And for a long time, this was a big deal. There were actually businesses that popped up all over the place that they were like consulting businesses that basically consulted small businesses and real estate investment owners on how to componentize their depreciation, right? And what I'm getting at here is this. Let me just go back up here for a second. Hang on one second. Whoops. See if that's going to let me do that. I don't know that it is. Okay, hang on one second. Oh, that's not what I want. Let me go back up to number 4. Okay, hang on one second. I'll get that queued up again. I apologize for the delay here. Okay, there it is. All right, so what we're talking about here is, in a nutshell, a couple of things. If you can increase the amount of depreciation you're claiming on a property, that reduces the amount of money you have to pay in taxes on the income, because depreciation is what's called a paper write-off. It's a phantom write-off. It's a write-off that's given to you by the IRS for the privilege of owning real estate and related property related to the real estate. So what that means is you have your real property, which is the physical building, the improvement to the land, okay? And then typically inside the real property, the improvement that is, you'll have other components that you can determine to be personal property. And when you do that, like refrigerators and stoves, for example, those items have a much faster depreciation schedule. So if the building itself is depreciated over 27.5 years, essentially it's going to take you nearly 30 years to depreciate a building down to zero, all right? But if you have refrigerators and stoves in there, those are often can be depreciated in like a 5-year period. Okay, so let's just look at some basic math here first, all right? And then we'll get into some examples of what you componentize or what you can depreciate separate from the building. So let's say you can get $20,000 in depreciation deductions on your ordinary income, right? And you're in a 30% bracket. That basically means you would save save $6,000 in taxes. In other words, $6,000 is 30% of 20,000, right? So this is like found money. And if you took that $6,000 and made a down payment on a $60,000 property, okay, with a 20% annual return, you would be adding $12,000 to your income every year, while you save $6,000 on taxes, right? So literally, that's what I'm saying is you don't just save on taxes for the sake of saving. You save on taxes for the purpose of reinvesting that, redeploying that capital, okay? Now, the beautiful thing is, let's say down the road, you want to sell a property, and you don't just flat out sell it, you exchange it through what's called a 1031 exchange, okay? What that means is you can see it right here, you have no recapture. In other words, you don't have to recapture all that depreciation, all right? And the tax savings, you do not have to pay these tax savings back by selling the property tax-free via the 1031 exchange. We'll cover that later. But in any case, the bottom line is this. You'll continue to pocket all those savings on depreciation, all right? And what it amounts to is this, is, it's like the law of attraction. Sound money practices attract more money. So by saving on taxes and redeploying that savings in the further investments, you're really compounding on a large scale what you're able to accomplish in your investing business. So let's talk about what this really looks like. All right. Some people call this cost segregation, but the bottom line is, if you have components, here's what we're talking about. If you have components like refrigerators and stoves, for example, that you can depreciate in shorter periods, shorter time periods, like 5 years. What that means is you have a greater tax benefit, greater tax savings, and that's money that you can use again to redeploy. So that's what we're talking about here. There's 5-year property. Here's a bunch of examples, all right? And again, most buildings are depreciated in 27.5 years. Older commercial buildings are 39.5 years. They've actually combined those over the years, right? But let's say you have in there other components like appliances, shelving, cabinet storage that are not permanent, that are not permanently a part of the building. You can depreciate those on a much faster scale, like 5 years. It was 27.5 years. So in other words, if you have a $10,000 component, like a set of kitchen cabinetry that you did not, it's not a part of the permanent structure of the house, $10,000, you depreciate that over, let's say a 27.5 year period. You can write off then, $275 a year on that $10,000 set of cabinetry. But if you depreciated that over a 5-year period, that means you can write off $2,000 a year, nearly 10 times as much. It's just amazing what you can accomplish by doing this. And there's some really neat things here. If you do a remodeling project, you're basically rehabbing a property. I'll show you here later on how you can recategorize some of those remodeling or rehab components to be expenses taken in that current year, and you can depreciate them over a shorter period of time if you choose to do that. There's 2 options there we'll talk about later. All right. So in any case, there's an example here of an investor who installed $80,000 in non-weight bearing movable walls in his commercial property. All right. As a result, because they were not a permanent part of the structure, he was able to depreciate those over 5 years. In other words, he had a deduction of $16,000. In other words, $80,000 divided by 5 is $16,000. All right, year over year versus $2,000. Okay, pretty amazing difference there, right? I mean, how would you like to have a $16,000 write-off this year, right? Because you use a certain type of wall structure. So in any case, there's other types of improvements too that most people are not even aware of. Even a lot of investors I find out are not aware of. In other words, typically, or I would say not typically, according to the code, land is not depreciable, okay, because land is land. It's not the improvement we're talking about, it's the actual raw land. But if you make improvements upon the land, okay, did you guys know that paved surfaces, landscaping, parking lots, you can depreciate those over a 15-year period, okay? You can also make land improvements to a building. Some examples might be outdoor lighting, okay, utility connections to a building, things like that. So really get real detailed in your analysis. If you had to run a new line from the power pole in your street to your property, okay, that would be considered a land improvement to the building, all right? If you had a new driveway put in on a rental property, that would be a land improvement to the land, and you could depreciate that over a 15-year period. So in any case, the reality is this, is you want to have the value of your land be as low as possible relative to the overall value of the improved property, because you can't depreciate land. And the lower that value is relative to the overall, property, the more tax savings you have. In any case, let's talk about a rehab and remodeling here real quick before we move on, and then we'll take another short break and check for questions. Oops, that thing just reduced all of a sudden for some reason. Hang on one second, I think I know why. No, you know what, I'm not going to mess with it because I'll mess it up. So we can still read this, so that's good. In any case, what this is talking about here is when let's say you're doing a big remodeling project, remember, you don't want to add the entire cost of the remodeling project to your cost basis of the property, because in there you may have components of the remodeling that could be depreciated on a much shorter scale. All right. In other words, if you're making modifications to the actual building itself, like roofing, siding, yeah, that would be typically 27.5 years. But let's say you're doing carpeting or cabinetry or appliances, you would want to depreciate those components over a much shorter period of time. All right, that's what we're talking about here. So, in any case, I just wanted to really focus on that for a second. We're going to move on here in a second. Let me cue this up. Before we do, hang on one second, and let me check for questions. Okay. So Fassel says, how do you find a good CPA that understands all this? Actually, Fassel, we're gonna talk about that here in a minute. So good question. And the thing is, we can add those guys to our community site, but a lot of tax accountants generally provide services in 1 or 2 states only. What we might do is we might go and entertain that idea, and for each the top 500 metropolitan areas, and open it up to one accountant per area or something like that. We've talked about that, but we don't want to inundate you guys with a bunch of choices that you really don't need to make. We'd rather just provide you with 1 or 2 that makes sense. So we're going to cover that here in a second. Let's see, Natasha has a question. Hang on one second. Do you suggest stocks, mutual funds to achieve doubling $1 for 20 years to 1 million? Actually, Natasha, I recommend real estate. I'm not suggesting that you don't invest in stocks and bonds and mutual funds. I mean, I do personally. All right. However, over the years, I have absolutely made far more money. I've got a greater return on my investment in real estate than I ever got from the stock market. See, in the stock market, you have literally no control. There's only 2 things you can do, which is get in and get out. In real estate, you got all kinds of things you can do while you own a property. You can change the character of a property. You can remodel it and raise the rents. You can remodel it and sell it. You can lease option it. You can do all kinds of things. If it's an LLC, if you own property in an LLC, you can sell shares of the LLC. All kinds of stuff you can do with real estate that's you really just can't do in the stock market. Now, what's funny is the stock market is actually doing quite well right now. And one of my clients happens to be one of the managing directors for one of the large international financial planning firms, and he's obviously invests in stocks, but he also invests heavily in real estate. And his objective is to see a $30,000 Dow Jones Industrial Average, and I think he's going to see it. I don't know, how long it's going to take. I think we're going to go through another painful recession here, unfortunately, but I think it will rebound, and just like it from this last one it did. Look at where it is now compared to where it was prior to the last recession. If you look at the history of the business cycles, it's a cycle. It always goes up, it always goes down, it always comes back around. So in any case, I suggest you have a balanced portfolio. That's really my, that's my suggestion. I'm not a financial planner, obviously. But I have different investments for different purposes. I think everybody should look at it that way too. So, in any case, let me check for more questions here. 1 second. Hang on just a second, guys. Actually, I think we're caught up. And let's look at repair deductions, okay? So, all right, 3 major tax-saving benefits of classifying expenditures as repairs rather than capital improvements. Obviously, one of them is immediate tax savings. So if you capitalize a repair as a capital improvement, you don't get to write that off that year. You have to add it to the cost basis of your property, which means you can depreciate it over time, and then eventually when you sell the property, you recoup either the gains or the losses, whichever the case may be. Okay, so if you're an owner of a rental property in a 31% tax bracket, and you pay $20,000 in a repair, it's an immediate deduction that would be worth $6,200 to you in savings if you could take that expense that year. But if you categorize it as capital improvement, and this guy says it's capital punishment, it must be written off again over a 27.5-year period. Average annual deduction of about $720. Tax savings of only about $200 in the first year. The difference in immediate tax savings of $6,000. So the way you do that again is componentizing, okay? So you have to look at the nature of the repair, and there's a lot of, believe me, there's a lot of rules about this. And you just need to know that there are different different schedules for different types of improvements. So in any case, so just like here it says, just like in a big forest, there are many smaller separate trees. So an extensive plan of improvement is made up of a series of smaller separate repairs. This is how you want to think of this. So that is, much work is resulting in permanent improvement to the property and assets consists of a series of separate repairs. Such repairs could be immediately deductible if documented separately. Otherwise, they will lose their nature as repairs if they are part of a general plan of improvement or reconditioning. So therefore, what you need to do is componentize or fractionalize a large expenditures into a larger number of smaller repair categories. All right. So it takes a little bit of work to accomplish this. You're basically going to document a bunch of smaller little individual components. So let's say you're doing a remodeling project. Instead of writing a check for $20,000, you would write a whole lot of other checks for $250 for this and $197 for that. It has to be legitimate. You can't just make stuff up. But let's say you replaced a faucet in your kitchen and it costs you $197. Well, you should write it off as an individual expense instead of basically lumping that in with a much smaller project, like a much larger project, like say you remodeled the kitchen, okay, and you replaced cabinetry and flooring and doorknobs and light fixtures and switch plates and countertop and sink and doorknobs and drawer knobs and things like that. What you should do then is break out the door and drawer knobs, break out the faucet, break out the light fixture, break out the switch plates, and write those off as expenses that year. And then anything that's a large dollar item, okay, you would still have to categorize that as a capital improvement and then write that off over a period of 27.5 years, or in some cases could be 5 years. If it's a refrigerator, it would be 5 years. So in any case, when you document this, guys, you want to use words like this: repairs, prevent damage, patch, temporary, incidental, minor, fix, piecemeal, annual, less than a year, decorating, painting, small. All these words are key words that the IRS is looking for to determine, is this really a repair or is it a capital improvement? Okay. Recoat, resurface, repaint, redo, all these things are going to be in your favor as far as deciding if these expenditures are repairs or not. When you do that, what's happening is when you get to write the expense off that year, okay, let's say you spend $1,000, you get to deduct your income from the property, deduct that $1,000 from that income that year, so you reduce your tax burden by $1,000. But if you depreciate it over 5 years, that means you only get to do $200 that year, and then $200 for the subsequent 4 years, and a write-off. Okay. Or the benefit to you is to that amount. So that's why you do it. In other words, you're keeping more money in your pocket more immediately that you can use for further investing. All right. Now, here's the sixth strategy. Here is a little bit unique. We don't really have to spend a lot of time on this one. What it has to do with is using FHA financing to buy rental properties. So let me check here for questions. I thought I saw a few questions come in before we continue. Okay, this is from Maria. Maria says, what about exterior painting and rebuilding your upstairs deck paid to one contractor? So Maria, what I would do is both of those I would consider capital improvements. Painting the exterior of the building, that's actually part of the physical building itself, so you can't really get away from that one. But the deck, so you said right here, rebuilding. That's one of those words. You might say that's repairing, okay? Because if you're rebuilding, are you simply replacing what's already there? In other words, you're not building new, you're not adding on something new, you're actually replacing what's there. So if you're replacing what's there, you're replacing the underlying structure, in other words, the beams and joists and posts and things like that, or are you simply just replacing the deck boards and the handrails? If you're just replacing deck boards and handrails, I would consider that an expense. If you're replacing the actual support structure and you're getting into thousands of dollars, you might want to depreciate that as opposed to write it off that year. Okay. Let's see. That was Fassel's question. Okay. Maria says it was out of code, so the support system stayed. So the support system stayed. Okay. Well, that's good news then. So I would say, Maria, I'd say that you can write that off and obviously clarify this with your tax accountant. But to me, you can write that off as an expense that year. So good question. Okay, let me check here one more time. Hang on one second. Now, what this next one has to do with is, and you should probably learn it so you can explain it to your investors. You may or may not want to do this yourself. You may already be living in your own property and you don't want to buy a multi-unit property for the purpose of living there. I mean, some of you might want to do that. I actually did that in my early years. When I would take advantage of FHA financing early on, I'd buy a fourplex or live in one unit, buy a duplex, live in a unit, things like that. So that's what this has to do with, because what's happening here is with FHA financing, you can get in with very little money down, sometimes as little as 3% or 5%, okay? And you also can get a 30-year term. In other words, your mortgage is amortized for 30 years. So a good example of this would be a lot of foreign investors use this strategy, by the way. They'll buy a property for their child who's getting ready to go off to college or go to university, as we call it up in Canada, all right? And what the investor will do is buy a property around the campus that maybe it's a single-family home with 4 bedrooms and they rent out all the rooms to individual students, or they buy a fourplex and they rent out the individual apartments to maybe grad students, okay? As long as their child lives in one of the units, they can do that. So let's say you paid $250,000 for a property and your monthly mortgage payment comes to about $1,250, okay? And you're bringing in $2,200 in rent. In other words, $1,100 per unit times 2 is $2,200, all right? What that means is you've got rent coming into the tune of $2,200, and yet your mortgage payment is only $1,250. You're making about $950 a month, okay? But at the end of the day, you got taxes, insurance, things like that. So let's just say that's what you're getting: taxes and insurance. Your total payment is $1,550 a month. If you were renting out one of the units for $1,100 and you lived in the other unit, then you're not going to get another $1,100. You're only going to get $1,100 per month, obviously, because you're living in one of the units, right? What that means is the other tenant is paying $1,100 of your rent to you, and your total payment's $1,550. That means you literally put, you're living for about $500 a month, roughly speaking, okay? Much better than $1,100 a month, and you get all the tax write-offs, okay? So essentially you can do that, and you do have to live there. There's rules about length of occupancy when it comes to selling your property, and is it deemed a personal owner-occupied property versus a tenant-occupied property. There's rules about how long you live there, how many years that you live there for 2 of the last 5 years, or 3 of the last 5 years, whatever the case may be. Okay, but let's say you did, and you lived there for 2 years, and you moved out, and you did rent out the other unit. Now you're in a positive cash flow position by a large stretch because you got a low interest rate loan for a 30-year period. Okay. In any case, initially, when my first property, guys, my total outlay per month was about $50. I had a 4-bedroom home. I rented the other rooms out, and I lived for a whopping $50 a month. And I sold the property after 2 years. I had about $3,000 into it. I got about $8,000 out. So I got $5,000 back because I owned it for 2 years, and I only had to spend about $50 a month on living expenses. Okay, just an example there. So let's say here again, when the investor inevitably moves out, it will generate $2,300 plus utilities, and will still save the same $50 per month on principal and interest. Okay, essentially have about $750 a month positive cash flow. All right. So in any case, the bottom line is, guys, don't I know we don't speak favorably of FHA financing when it comes to investor transactions, but I wouldn't completely write it off. Um, no pun intended, write it off, get it? I would explore this and talk to your local banker. They should know all these rules. Find out what's possible for your investors. Okay. So in any case, next strategy um, has to do with leveraging your money in today's market. So let me real quick check for questions again. Hang on one second. Um, Actually, I think we're okay on questions. Hang on, let me just double check one more time. Okay, I think we're okay. All right, let's see here. Let's say you go out there and you're looking to invest. In today's market, obviously interest rates are still very, very low relative to historical averages. Okay, what I would do is this: don't be afraid to use your own money. I know that sounds startling to a lot of people, but quite frankly, I will tell you, over time, on a cash-on-cash basis, the people who actually operate from cash actually make more money. If you're highly leveraged, you're up to your eyeballs in loans, hard money loans, and private lending, all that kind of stuff. Man, you're just it's very difficult to dig out of that. Your cash flow is going to be tight. Stuff always seems to pop up. Life happens, right? So in any case, let's look at this. Um, one of the best things you can do right now is to buy properties that are already in service. They're already up and running. They don't have a lot of deferred maintenance. They're already performing, providing positive cash flow, and you can get loans still for around 4.5%, commercial loans actually. Okay, and your property the day you close on it is generating revenue for you right away. And the cool thing is, if you have a bank mortgage on it, typically you don't have to make your first mortgage payment till the month after you close. So you get a whole free month of free income coming in. All right. With no mortgage payment. Also, if you close in the middle of the month, you get the rest of the rent for that month too. All right. So potentially a month and a half of rent's coming in with no mortgage payment. In any case, to get a down payment, here's where we really ruffle some feathers, but I tell you, once you do this, you'll get used to it, and it works very well. If you're going to borrow money, don't borrow from others. If that's your mindset, use other people's money. All right, borrow, but borrow from yourself. Borrow from your own 401k if you have one. I mean, I did that probably several dozen times over the years. You can typically borrow up to half the value of your 401k, and when you pay it back, you're not paying back somebody else. You're paying yourself back. So not only do you get your property you want to purchase, you get your 401k built back up, and in any interest you pay to yourself. It's the most amazing thing. All right. You can also get a down payment from a whole life policy. Use the cash value. All right. And by the way, cash values in whole life policies are historically very, very low. So it's better to redeploy that cash value. If you already own other properties, you can also get a commercial line of credit against the equity in your other properties. If you have a good performing portfolio, solid equity and cash flow, that's a great strategy. Again, you're borrowing against yourself, okay? You can also just flat out use cash. And I said it, use cash. When you're coming out of recession, all right, or any recession, one of the best things you can do is to use as much cash as you can, because most people don't have it, and you can really command the best deals. Your cash is king, always has been, always will. Quite frankly, values are going to go up anyways. You might as well lock into the low prices, pay cash for it, and then coming out of a recession, you can start to put equity loans on those properties that are in the first position, by the way, to free up your capital and still keep you in a really solid equity position. So, in any case, so Fassel, this is for you. Avoid inept CPAs, okay? Basically, if you're not satisfied with the tax accountant you have, I would look for another one. So here's some questions, some things you can do to help yourself when it comes to hiring a tax accountant. All right, ask them questions and see what their answers are. Now, this was kind of a joke, but really, what they're saying is if you ask an accountant what's 2 plus 2 and they tell you 4, you might want to ask for a different accountant. But if they come back to you and say, well, what do you want it to be? You maybe have your guy. Now, I would never suggest you do anything that's going to put you in a position to be audited, or worse yet, not follow the code or even interpret the code inappropriately. You always want to, fall within. Always use the code in your favor and use it appropriately and correctly. Okay. In any case, if you went to 50 tax accountants and ask them the same questions, you might actually get 50 different answers. So if you have the right tax accountant, often you can save as much as 50% more on your money. So in any case, here's some questions you can ask them. Can they tell you about the most recent tax changes and how they might affect you or what may interest you? Can they plan your tax to ensure the best possible outcome under different scenarios? In other words, can they give you a couple different what ifs so they can let you choose from? And ask them what steps they would take to reduce the chances of your return being audited. So so I would take those 3 questions, and those are the ones you can ask yourself, or you can provide to your clients, so that they can themselves go out and make better wise decisions on who they choose as their tax preparer. In any case, this paragraph right here, Faisal, this is really what you want to focus in on. The bottom line is, just like a bad tenant, a bad tax advisor can really hold you back, basically financially. Here's some questions here. Let's see. Can you provide references from other real estate investors in your area? How about that one? When you're checking them, ask specific questions like, did they come up with tax-saving ideas that others didn't think of? Were they thorough by explaining the tax situation? Did they call you during the year to make tax deduction suggestions? Would you recommend them to your mother? Okay. So you want a tax advisor who can assist you rethinking your tax situation under current laws, especially those affecting real estate. Can they apprise you of tax reduction opportunities, old and new, alert you to IRS tax traps, give you prompt, courteous service, be ethical. All right, so those are, I would print this off, keep this with you, but again, provide it to your clients, guys. Okay, so that's that one. All right, we're getting close here. Another thing too, which is kind of an obvious one, you'd be surprised at how some tax accountants are not fully aware of the code and how different types of income are categorized. So one clear example is this. This is the most obvious one. Rental income is considered passive income. What passive income means in terms of the IRS code is you don't have to pay Social Security tax on that. You do have to pay income tax on it, but not Social Security tax. Okay, it's not earned income. It's called passive income. Only earned income can be taxed with Social Security taxes. All right, and we've seen a lot of tax accountants who actually would apply your passive income as if it was earned income and have you pay Social Security taxes. Right. In any case, and a lot of this stuff, after a certain period of time, you can't undo this kind of stuff, all right? So, I mean, there's an example here they give. Let's see here. For 7 years, let's see, this is, I've seen this happen numerous times. CPAs numerously classify rent income for the use of property as self-employment Social Security income, all right? It's not self-employment income. It's not employment income at all, right? But they do this, causing the investor to pay another 15% of income on their taxes. For 7 years, this happened to one of my students with the self-storage facility. When they realized the CPA's blunder, they could only go back 3 years. That's the rule. You can only go back 3 years to amend your return. It was too late for the prior 4 years, and it resulted in $10,000 in taxes that did not have to be paid. In any case, let's go on to the 10th one here, because this is something that this last piece here is something that you can apply on a transaction by transaction basis to help your clients in current day activities. Okay, so let me do a real quick check on questions again before I give you this last one here. All right, looks like we're okay. Okay, I want you to think about your last transaction you had, and think about the HUD sheet. Or if you want to pull up a HUD sheet, okay, you can take a look at it, and you'll see on any HUD 1 settlement statement on a closing on a real estate transaction, there's the buyer column on the left and the seller column on the right. Okay. Now let's say you're negotiating a transaction, a sales agreement, and you're getting real close, but neither party's willing to budge, and you're down to within a few $1,000s. And there's a couple of things you can do. All right, number one is, even while it's customary for the seller to pay for commissions out of the proceeds they get on the sale of a property, there's no reason why you, the agent, can't alter the sales price so that the net proceeds to the seller are the same, and have the buyer, right, have the buyer take on the expense of paying the commissions. So let's say you have a $100,000 property. The sale is going to be $100,000. All right, commission is 6%. The seller would pay 6% of that in the form of commission, so their net is $94,000. What you can do is say, Mr. and Mrs. Seller, if you will take $94,000, my buyer client will pay the commission. Okay, and you're wondering, okay, why the heck would he do that? Well, the bottom line is, to the buyer, paying that commission can be written off as an expense that year. Okay, and for the seller, they would use that to offset their sale of the property, offset the gain. So the effect to the seller is it's nil. There's no effect. The effect to the buyer is that $6,000. If they're in a 30% tax bracket, at the tax time, they could recoup almost $2,000 of that. You see what I'm saying? So if you're within $2,000 of an agreement, in this example, a $100,000 property, use that strategy. Okay, that doesn't affect the seller, and yet the buyer can basically get the property they want. It's just they're going to get in a delayed way at tax time. They'll recoup the extra that they had to pay on that property. Okay, you can do the same thing with transfer taxes. There's a number of things you can do that for. So again, transfer taxes. Let's say you're paying 1% each. Buyer pays 1%, seller pays 1%. You can have the buyer pay both of those, right? The seller's and the buyer's transfer taxes, and again, write that off as an expense. Okay, and they get back 30% of that at tax time, so they can net the price to look more favorable to the seller, and yet the buyer gets a tax advantage that they can repay themselves back at tax time. So, in any case, just wanted to bring that to your attention. It's a real good technique for us when we're close on negotiating strategies, and it does have a direct effect on your clients' tax returns when they file taxes at the end of the year. So, in any case, guys, I hope you enjoyed that. Those are the top 10 tax strategies. We did the most complicated ones first and moved on to the simpler ones. Again, I highly encourage you to print these off, save them on your hard drive, either send them to your clients in a Christmas card, or Kwanzaa card, or Hanukkah card, or email it to them. Okay, and just say, Happy Holidays, Merry Christmas, whichever the case is, and they'll remember you for that, as opposed to just sending them a recipe or a magnetic calendar. All right. In any case, let me check for questions here one more time, guys, before we call it a day. It looks like we were, hang on one second, looks like we might have another one here. Okay, this is Natasha. So hi, Natasha. Okay, I just shared the multi-unit FHA strategy with a potential young buyer this afternoon. This is great to hear you discuss this topic this evening. We're sitting down on Thursday to locate best rental income producing areas. Hey, that's awesome, Natasha. By the way, congratulations. Please keep me posted on that. Okay, Roger's asking, would a REIA group usually have a good source referral for tax accountant? Roger, yes, a good REIA group will. By the way, if you're, I know you're up in New Jersey, go ahead and look up Teresa Martin. She runs the Long Island REIA group and the Manhattan REIA group. She's one of our students. She's an attorney. And she and her team leader and OP, all three, are in the training program. But she may know somebody that can do that for you in New Jersey, because a lot of providers provide resources in New Jersey and New York at the same time. So good question, and good to hear from you too, Roger, by the way. So in any case, hey guys, listen, I want to wish you all personally a very Merry Christmas. We're not meeting next week. We will be meeting again the following week, which is that means I won't be seeing you till next year. But that webinar is my birthday, Thursday, January 5th at 7 p.m. Eastern, 4 p.m. Pacific. So I don't know what the subject's going to be yet, but we're likely to go back into the material and start from the very beginning and work our way through just like we did last year. And then from time to time, we'll take a week off. I mean, we'll still have the webinar, but we're going to dig into specific subjects that you asked me about. But most important thing right now, guys, is this. A lot of you have had a real good year. I mean, some of you had as many as 3 transactions in your first month. You know, anybody that needs help, if you need moral support, spiritual inspiration, you know, please let me know. As you know, I'm on the road a lot. I will tell you on January 2nd and 3rd, I will be on the road for 2 days driving from London, Ontario, Canada, all the way down to New Orleans, Louisiana. I know it sounds crazy. Why am I driving that? But I have to have my car going through Louisiana, Texas, New Mexico, Arizona, Nevada, and Southern California because I'm not going to be flying all those places and renting all those cars. And I'll have my skis with me and my boogie board and wetsuit. So no matter where I'll be able to either ski or surf. In any case, on those 2 days, it'll be a great time for you to have a pick-me-up phone call. Let's talk about what you're looking to accomplish in 2017. I will tell you this, all indications are this is going to be a bang-up year for investing and working with investors. Much better than 2016, which was much better than 2015. In fact, the results in 2016 were almost double what they were in 2015 across our student base. So we're looking to do that again this year, and so far what we're seeing is it's really panning out big time for a lot of you guys. So keep me posted. Boy, if you got some good success stories, guys, man, shoot them to me. Email them, text me. If you need help, same thing, just let me know. Okay, Merry Christmas to you guys. Jackie, Doris, Merry Christmas. You know, all of you guys, Maria, thank you very much. Yep, I'll be a young 29 years old. So, okay, I'm going to go ahead and turn off the recording, guys. You guys have a wonderful weekend and week ahead with your families and loved ones. Just relax and smile because 2017 is going to be an awesome year for you all. All right, take care and God bless.